Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
You know, we love the big take stories here. Bloomberg News, almost like on a daily basis, puts out these big take stories, really deep dives, deeply reported, teams of people focused on this thing, and they go deep and they get good data, good reporting. And today is a big one. Biden's EV dreams are a nightmare for Tesla and the U.S. car industry. Craig Trudell joins us, Global Autos Editor for Bloomberg News on Zoom from London. So, Craig, this is a big deal here because President Biden, that Inflation Reduction Act, putting a lot of money behind EVs here, but you can't take China out of the equation here. What's happening?
Yeah, I think this is a really challenging thing that the Biden administration was trying to do, right? They were trying to jumpstart the EV industry in the U.S. I would say, you can give them high marks for what they've done in terms of the amount of manufacturing investment they've attracted. It's really been remarkable, the response that we've seen there. On the other side of the equation, the demand side, I think, the marks are way more mixed. And I think, the challenges that we're going to see in the years to come, assuming, of course, IRA, stands up if we see a change in the White House later this year. But whether or not manufacturers can sort of pull off what Biden, is asking of them, which is to really set up a EV and battery supply chain that is less reliant on China and eventually is just not reliant on China. And that's proving to be an extremely difficult task. And that's what we try to lay out today in ways that are, really, it's a complicated issue. Tesla, everyone thinks about as, being a very sort of made in America car brand. And they sort of are recognized as one legitimately, but when given the opportunity to import batteries because of the fact that the IRA, didn't really necessarily grow some teeth until the beginning of this year, we saw, just in a matter of months, Tesla import $2.5 billion worth of EV batteries from China.
Wow.
And Craig, that's happening because it feels like every time we talk about GM, Ford, Tesla, a lot of these companies are losing money making their EVs. So what was the point of the IRA if not to kind of streamline, I guess, the kind of inputs of these batteries?
I think what you have here is a situation where, Joe Manchin was the player who, Washington really just had to sort of bend to his will. And he was really reluctant to, allow for electric vehicles to continue to get tax credits. He was opposed to them. And he said, okay, industry, we'll give you these tax credits, but you build me a supply chain. That, of course, sort of didn't take into account sort of, the complexities of the supply chain and the fact that China is just so dominant in this space. And they've really sort of, methodically, for a time quietly, built this staggeringly strong position in terms of, the control of, the inputs, whether it's, nickel and lithium, graphite, these inputs are going to be really, really difficult to source, not only just, whether they're mined in China, but whether they're sort of processed and refined. And, the sort of cost difference that the West is going to have to sort of overcome really just can't be, sort of overstated at this point.
And folks, if you want to see this article, it's a fantastic article, really deeply reported, great graphics, makes it easy for me because I like the pictures. Bloomberg.com/big take is kind of where you find it, big team effort. So, Craig, I see in your reporting here, in 2023, the IRA required that at least half of the value of battery components had to be assembled in North America and that 40% of the raw materials had to be sourced from the U.S. And in 2027, that raw material requirement is going to double to 80%. Are those numbers, can they be achieved in that time frame?
I think that's one of the things that, it sort of depends on which company you ask. And I think, some of the concerns that the industry is having here is the fact that some of these raw materials, the prices have really collapsed. And, that you would sort of think, oh, that's a good thing for the auto companies. But if you're trying to build a supply chain in North America for these raw materials, and the prices for them have absolutely, sort of the bottom has come out. I think of lithium in particular, you've seen just this dramatic, drop in prices that significantly undermines the economics of those projects. And so, I think the raw materials in particular are a real challenge. I think battery components will be less of a challenge, but even there, it is, a matter of you can't just sort of snap your fingers and open up a bunch of plants for these various components. It does take time, to put, dig up the ground and put up these plants that are coming, but are taking some time.
And Craig, across the automakers, I'm looking at the reporting again. 7 of Tesla's 12 models sold in the U.S. fully cleared the IRA's sourcing hurdles and qualified for the tax credit. What percentage of EVs being sold in the U.S. are clearing that hurdle?
I think because Tesla is still so dominant in the U.S., we're at a point where the EVs that do the most volume are largely qualifying at the moment. But I think the fact that those raw material requirements that kick in next year and then escalate in the years that follow, that's really where we're going to see even more of a sort of level of screws put on the industry. But I think, the other car maker that I think is particularly well positioned, I'll call out to General Motors. I think the fact that they have a localized supply chain for batteries, they have a joint venture with a Korean battery supplier. We're seeing, more and more of those partnerships, Ford following suit, Stellantis, the maker of Jeep and Chrysler, similar deal where they're setting up battery plants in North America and sort of on and on. But those projects, I would say, are much further behind where we have Tesla, which, for years has been making batteries out in Nevada with Panasonic, and GM, which has a partnership with LG in U.S.
Hey, Craig, I think the narrative out there, just kind of the bigger picture on EVs right now is, maybe demand isn't as high as we all thought at one point. We've got, the big auto manufacturers pulling back, like Ford, for example. Loss is still big. What's your understanding when you talk to your sources as to how people are thinking about the ultimate demand for EVs over the next 1 to 3 to 5 years?
I think, perversely, it was a challenge that, for a time, business was too good. The fact that, for a while there, so many companies, actually had back orders. Tesla in particular, had demand issues as opposed to a supply issue. That, really sort of caused this, unsustainable, jacking up of prices. The fact that has had to come down, I would say, more dramatically than we've seen for the rest of the industry, has had all sorts of, unintended consequences. When you, so dramatically bring down prices on the new side, the used side is of the equation. The used vehicles really lose their value. And the fact that I think EVs maybe have some sort of, particular challenges with, maintaining their value. When you think about a used gas car, you don't worry about, the engine holding up. You maybe have, relatively more concern, rightfully or not, as to whether or not the battery is going to hold up. And so what we're seeing is that really come into play in terms of total cost of ownership. I think that's one of the things that we've really paid close attention to lately. I think when we step back, the fact that EVs is sort of, the way forward, particularly in terms of, where the regulators want to see this industry go. I think we've seen that China is able to make this work. We've seen that Europe is much further along in this transition. I think the question for the U.S. is whether we can sort of, get Americans who tend to like bigger vehicles to come around to electric vehicles. I think that also adds some complications to the mix as well.
All right, Craig, thanks so much. As always, Craig Trudell, Global Autos Editor for Bloomberg News, joining us via Zoom from London. I tested, thanks to Matt Miller's connections with Ford. He got me a F-150 Lightning, the EV.
Ooh, yeah.
I got the test drive of that for like a week.
How was it?
Awesome. Now, I have to, full disclosure, I'm a Wall Street guy. I don't drive pickup trucks. So it's the first pickup truck I ever drove. It was awesome. And it's the first electric vehicle I ever drove. But the sticker price was $94,000. And I think it's just one of the challenges they have is just cost.
Yeah. No, well, and that's going to be, interestingly enough, we get earnings from Rivian and Lucid after the bell today. So we're going to hear how some of these smaller EV makers are hanging in there, just given, as you mentioned, high costs. These companies are losing money on pretty much every car or vehicle they make, and demand doesn't seem to really be there.
Yeah. So anyway, big take story coming out of Bloomberg News today, looking at the the battery side of it and kind of where we're sourcing all this stuff. So again, Bloomberg.com/big take, and that's where you'll find it.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's check in with Ira Jersey here, because I want to know what my Federal Reserve is going to do. I mean, I've got, the Fed watchers, they were pounding their chest. March, we're going to get a, rate cut.
6 rate cuts in a year.
And now it's kind of May. Now people are talking about June. And we've had a couple of smart people come in here over the last couple of days and say, hey, you better have a scenario where they raise rates. So I have no idea what's going on. So let's bring in Ira Jersey, because it's his job. Ira Jersey, Bloomberg Intelligence, Chief U.S. Interest Rate Strategist. Ira, it seems like this thing changes day by day, and I guess that's why the good folks at Bloomberg made the WIRP function, because it just changes all the time. It's a fluid situation. Given kind of what we know here in the economics and some of the data we've seen, how do you think the Fed's feeling today?
Yeah, so we're get a lot of Fed speak this week. We have the minutes at 2:00 today, so we'll see what they were talking about in some more detail than we got during the press conference from the January meeting. But my view has always been that we were probably going to only get a few cuts this year. So we thought 3 cuts going into the year over the course, and part of the reason for that was we thought that it would be pretty slow going in getting inflation back toward the Fed's target. And so far that's played out more or less the way that we thought. So we'd been figuring that they would cut one time before middle of the year, in part to kind of get that first cut over with before the election, and that gives them some flexibility depending on how the numbers come in. That being said, as you noted, Paul, one of the factors that we highlighted last week was that people are buying options on the potential for higher rates. So there are some people who are getting a little bit concerned that there might be this tail event where maybe the Fed is on hold most of the year, but sometime in say the fourth quarter, maybe just after the election or something, they have to hike because inflation and the economy is holding up reasonably well. So even though that that's not a base case of just about anybody that we talk to, although there are a few outliers there that certainly think that that's a possibility. I think that an on hold case is much more likely, and you've heard some people in the fixed income markets talking about that as being more and more realistic possibility that the Fed just doesn't cut for a long time or doesn't move at all.
Yeah, Ira, with that notion, hold higher for longer has been something Jay Powell said for quite some time. You're talking about a cut coming later in the year. Are we talking September, November timeframe?
So September, I think, will be a little bit hard, even though the Federal Reserve says that they're apolitical. But I think that they wouldn't want to start any new actions just prior to the election. And September is that meeting that sits in between the conventions and the general election. So I think that they wouldn't start anything then, which is again another reason why thinking that maybe they would do a move in say May, June, or July just to have it out of the way, and that gives them flexibility to continue those actions. It's definitely possible, just given the strength in the data, that maybe the Fed doesn't move or doesn't have to move until after the election. That's there's a non-zero chance of that, and I think that if we continue to get data as good as we've seen recently, then certainly that's a possibility. Again, like our view continues to be at the moment that the Fed will cut a few times this year, but not nearly as much as what the market was pricing, say, 2 months ago.
Hey, Ira, in your work looking at rates, what is the stuff you're working on now that maybe we're not asking you about, that maybe we should?
Yeah, well, so you haven't asked us about supply recently, because supply is certainly something that has gotten a lot of attention in the markets recently, just with all of the Treasury bond auctions and with deficits, $2 trillion-ish, and looking like they're going to remain at those kind of levels for the next couple of years, is something that is still getting a lot of attention, and is one of the reasons why it might be more and more difficult as time goes on, just given the stock of Treasury securities outstanding, for the market to rally, just because you have some supply demand imbalances. But interestingly, once we get through April, it looks like the Treasury Department will be able to stabilize the Treasury auctions at the levels where they'll end up in April, and because of that, you might have a better supply demand imbalance. So you might actually see a little bit more propensity for the market to rally when we're talking about more rate cuts than it has over the last year or so, as the Treasury Department's had to, keep on increasing the size of the debt.
Ira, what are you looking at? What matters? I was talking to a PM this morning who kind of laughed when I asked him about the minutes later today.
Yes. So within the minutes, it's the details, right? So the details matter, and so the two things that we'll be focused on are, one is the normal stuff, right? It's what is their reaction function? Has it changed? Is there the chance that some members have gotten somewhat more cautious given the strength of the data that we had in January, and therefore will there be a change in the dots and in some of their forecasts when we get the March summary of economic projections? But more importantly, and I guess this goes also to Paul's question just a second ago about what we're not talking about, but it's also a balance sheet runoff, right? So it's completely possible that even if the Federal Reserve doesn't cut interest rates at all this year and keeps rates relatively high, it is possible that the Fed is going to have to reduce the amount that it's running off its balance sheet. So there's so-called quantitative tightening, and as that happens, I think the market will take that as somewhat of a dovish bent to the Fed and the Fed activities. So you'll probably see things like risk assets do pretty well, right? Credit spreads tighter, equities do okay. The rate market will probably rally just a little bit on that, just as they'll take it as a dovish signal. I don't think it is, because I think that the balance sheet policy at this point is going to be somewhat disconnected from rate policy, because balance sheet policy has other implications in the banking sector, and how much bank reserves do people need in order to comply with some of the capital regulations and the like. So that's going to be completely different. But that is something in the minutes that I'm really looking forward to seeing what they talked about and how they're going to frame the discussion that they're going to have in March, because Jay Powell did say that in March they're going to start their talk about balance sheet policy.
All right. So I get home, my new hours, I get home in the afternoon, I turn on CBS. I see Inter Milan playing Atletico Madrid.
Yeah.
I think that's what I was seeing. Good match. I don't know why I was on the CBS network in the middle of the afternoon. That's another question. But Ira, what was I watching yesterday?
So the Champions League,
I guess.
So the best teams in Europe all play each other, or the teams that won their leagues or came in the top a couple of spots in their leagues. So Atletico Madrid would be playing Milan in the Champions League. The reason it's middle of the day is because it's evening in Europe.
But my question was, why was it on CBS network? I'm not watching some silly soap operas or game shows or something like that. So that's for me. That's a media question. I'll call my friends.
Yeah, CBS has the rights to the Champions League, just like NBC has the rights to the Premier League and the like. So you're going to see it on whatever network bought those rights in the U.S.
So who is favorite in the Champions League? Is that it?
Yeah, I think it has to be last year's champions, Manchester City, right? They're still one of the creme de la cremes, but the Milan teams and Bayern Munich and PSG, like those teams can never be ruled out for sure.
I'm an Inter fan, so
you were
watching my.
It was
team
at San
play.
Siro.
Yeah.
I've been to the San Siro.
Oh, really?
Yeah, some AC Milan played there back in the day. So
that's awesome.
Yeah, it was pretty cool. They are insane over there at the stuff that they do. I mean, they light stuff on fire, fireworks. I mean, it's just crazy. All right, very good. Ira Jersey, thanks so much. As always, Ira Jersey, he's our chief U.S. interest rate strategist. He's also our go-to soccer aficionado.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Bailey, you know it's bad when your cab driver says, are you going to be listening to the Nvidia call today?
No way.
I mean, this is going to be this thing. So the implied volatility, which you showed me from the Bloomberg terminal, is 10%. And for a company with 1.7 trillion market cap, that could be some shekels gained and lost here coming up. So Gene Munster joins us because we have to get the bottom line here, and Gene can certainly do that. Gene Munster, he's a managing partner, co-founder of Deepwater Asset Management. He's been all over the tech space for decades. Hey, Gene, have you ever seen anything like this where a company has not only a big impact, I guess, on itself, but even in its sector, but also kind of the broader market mentality? Nvidia is really outsized, isn't it?
Absolutely. Answer your question, I've maybe seen it back when the iPhone was starting to get going. It had an outsized impact on overall tech, but if you put that into perspective, that was iPhone 16 years ago. So it's been a long time. When you think about the transformation of AI, it's understandable that NVIDIA's gotten the attention and the expanding market cap that it's had over the past year, because of course it is in a pole position. It is benefiting tremendously from this AI infrastructure. That, of course, is all in the rear view mirror, and it's all about looking forward. But to answer your question, this is pretty special times we're in. One just final thought. Outside of their earnings here, if I look back over the past year and look what's happened to NVIDIA relative to expectations, how they've beat expectations, what they've done to guidance, that period, those 3 quarters, that's something I have never seen. Multi-billion-dollar company beating by 30, 40, 50%, guiding up by 20%, and then beating that upward guide by another 30, 40%. It is simply breathtaking from a tech investor's perspective.
Yeah, folks, and what you just heard is really has some gravitas, because Gene's been investing and analyzing tech companies for decades here. He's seen them from the cradle to the grave. So that means something. 1.7 trillion market cap company here. Stock's up 230% over the trailing 12 months. So, Gene, that tells me, boy, the bar is extraordinarily high here. What's a win for this company? What's a loss for this company here after the close?
I don't know what the stock's going to do tomorrow. It's hard, really, when you see that kind of volatility built in the options. That means there's a lot of jockeying beyond what's going on with kind of fundamental investors. So anything can happen. The stock could be up big on the print and could fade tomorrow. The opposite could happen too. From my perspective, what is most important is understanding how the commentary for the company is going to impact calendar 25 revenue growth. And just to kind of put this in a quick perspective, the company is going to grow this quarter at around 250% year over year. The growth expectation for calendar 24 is 64%, a pretty big slowdown because of the law of large numbers. And then another big slowdown in 25, down to 17%. And so effectively, investors recognize this company has been through just a breathtaking growth period here. But the general consensus is that the business is going to hit the wall. And even if you look at the valuation right now, it's actually a pretty reasonable valuation. It trades essentially in line with its earnings growth expectations for 25. So to answer your questions, what I'm looking for tonight is for CFO Jensen Huang just to reiterate what he has said related to where we are within AI. And just to briefly recap that, he has these 4 talking points. He talks about these 4 waves of AI. And the current phase that we're just starting in is big AI infrastructure. That's the hyperscalers. That's AI startups. Phase 2 is enterprise applications. That would be like Copilot. Phase 3 is going to be heavy industry getting generative AI. And he said that is the largest opportunity. Phase 4 is sovereign nations. I mean, there's a lot here. So my bottom line is that if investors ultimately walk away from this quarter, tomorrow, tonight, next week, and say we're still very early in this and NVIDIA's got a great pole position, then those expectations for calendar 25 probably start moving higher, which is ultimately going to be positive for the stock.
And Gene, when we look at it from a valuation standpoint, about 30 times 2025 EPS, when you look at what the path forward that you're mentioning for NVIDIA looks like, is it just continuing to grow the AI pie, if you will, or is it being able to fend off would-be rivals?
Well, I think that just the pie, the TAM expansion, I mean, this has been one of the talking points from AMD. If you look at what they've said at their analyst day last fall versus what they've said a month ago, they've basically said that the their addressable market would 4x, and then that was 3-4 months ago, and a month ago they said it would 2x from that 4x. I mean, these are just, it's mind-boggling kind of how fast these numbers are going up. And the reason why they're saying that is they're seeing the order flow. And so ultimately, NVIDIA's got an amazing product. They've got a product cycle coming up. They have basically a code and operating system that works around what these chips do. It's a developer platform. That's a better way to say it. So, but if they've got such high market share right now, 85% in the GPU market, it's really about continuing to expand the TAM. And I think that that's ultimately going to happen. I mean, I'm in the camp that AI is going to be more transformative, twice as transformative what the internet has been, which is hard to wrap your head around that. But I think that there's NVIDIA is just in a great position relative to that opportunity.
Well, you know, Gene, one of my questions is, you know, just as a layperson here as it relates to tech spending, how much of this tech spending associated with AI do you believe is incremental versus maybe just shifting it around from other budgets here?
The most commentary we've heard is from those big tech companies. Those are the hyperscalers. Yep. That's the companies like Google and Meta, Microsoft. Apple hasn't said as much, but they're going to get more into this. But what they've shared is that it is incremental. They've talked about, their typical run rate of CapEx. Let's just call that at a typical growth rate of 10, 15% a year. And those growth rates, the spending in CapEx is going to go up, call it 25, 30%. This is an average if you look at some of those big companies. So this is incremental. I mean, they're seeing this as you have to pay to play to invest in the future. And so I think it is incremental. When you kind of process, like go through the theory of this incremental spend, that's how you get expanding addressable markets, is when you get that incremental spend. When things are shuffling around, it's hard to get those expanding markets. But in this case, I think it is true. This is just a whole new infrastructure that's being built largely on GPUs versus the old infrastructure on CPUs, and that is incremental spend.
And Gene, as we've seen the valuation skyrocket and it's leaping above a number of well-known names, the Metas and the Berkshires of the world, can it catch Microsoft? Microsoft at just south of $3 trillion in market value compared to NVIDIA's 1.7?
I think the AI opportunity is big enough that it can catch that. I mean, if in fact I'm right, and I mean, this is a firm, Deepwater, our firm believes that this is 99 out of a scale of 0 to 100 is AI. Electricity is 100. It's that close, and the internet's 50. If that's true, yes, there continues to be this upside to. I don't want to get carried away, by the way, in the moment of kind of the hype. I'm just trying to step back, and again, I don't know what the stock's going to do tomorrow, but I do have a sense about how impactful AI is ultimately going to be. And so what is that kind of that high end of the market cap expansion? When I was talking about that fourth point, sovereign nations, this is countries needing to have their own AI to really reflect their intelligence and their culture. I mean, these are some pretty bold and big objectives that these very deep pockets are going after. And when you think about that relative to the market cap, you can build a case that it can go much higher.
Gene, thanks so much again. Always appreciate getting your time. Gene Munster, managing partner and co-founder of Deepwater Asset Management, NVIDIA after the close. Gene Munster, one of the best voice coming out of the Valley.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Potentially a big day in the market today after the close. We get NVIDIA reporting. We'll see what it means for that stock, for the tech sector, for the market overall. So let's just get a sense of what's happening out there in this marketplace here. Carol Pepper joins us. She's a founder and CEO of Pepper International, joining us on a Zoom call from NYC. Carol, thanks so much for joining us here. I don't know if you're a tech geek or you're into this whole NVIDIA thing, but boy, it's certainly had an impact on this market. Certainly AI has been a big, big narrative for this market. How do you think about that?
Well, AI is the next large trend that people need to ride. As you know, I manage money for family offices that have greater than $100 million in net worth. So we're always looking for the important long-term trends. And when NVIDIA burst on the scene and began to support the development of AI, it became a very interesting stock. The reporting today, whether it's up or down and whether the market likes it short term, it's a long-term play. So I tell people on a fear day when Nvidia is perhaps down a bit, even perhaps after earnings are announced, it might go down slightly for a few days. That's what happens. That's a stock to buy and hold long-term. 10 years from now, you'll be very glad you bought that security, because it's really a way to start riding the trend, as is Microsoft, by the way, because Microsoft is not going to let Nvidia take that whole market. They're starting to develop some new technology as well toward AI.
So, Carol, what else do you like in the call it AI semiconductor space then, if buying the dip or sell off on Nvidia and kind of the ripple effects does play out? Where else would you be looking to put money to work?
Well, I just think you want to go with a big basket if you can. So for a lot of the investors out there that aren't necessarily buying single stocks, you can look at even baskets like QQQ. There are other AI baskets that are going to be coming out very shortly. I think you buy market leaders right now. So I would stick with Nvidia for your main play on AI and Microsoft at the moment. It doesn't mean there won't be new players that are interesting coming forward. But at the moment, market leaders have continued to lead. So this has been a market where the biggest caps with the most money, whatever sector you're looking at, are leading. So don't get too cute. Buy the leaders just on a fear day when you can get in at a decent price.
All right, Carol, so you're mentioning Nvidia, Microsoft, two of the Magnificent Seven, people wanting to call it the Fab Five, as a shout out to the Michigan basketball team. What's your take on the rest of the group, just given kind of the divide that we've seen with Nvidia really kind of carrying the baton at this point?
Yeah, well, the one I would toss out, which I think will get tossed out itself, is Tesla.
Oh.
I mean, I think Elon Musk is, his attention is too divided between too many things, and he's becoming a political liability. He's putting himself far out on the spectrum. So that's the one that I would toss. I don't think they're going to be a market leader 5 years from now at all, because his attention is too split and he's too troublesome. So I'd get rid of Tesla and I'd buy the others as a basket. My favorite stock for years and years has been Amazon. I think that will continue to be a strong leader. They're continuing to expand, and that they will take over the pharmacy space eventually. That's something they're trying to do, and that's a stock to watch.
Hey, Carol, you've been in this managing, the wealth of these high net worth families for decades now. How has that changed? How has that business changed? What are your clients? Are your clients today different than maybe they were 20 years ago?
Yeah, I think family offices and high net worth individuals have become extremely sophisticated over the last 20 years. Most of them have pulled the asset allocation decision and the stock selection decision inside of their own private family offices. That's what I do. I act as a CIO to the single family offices. They used to give all of those decisions to the banks, but that's like, handing the fox the keys to the hen house. They understand that banks are actually like supermarkets, and you should go shopping at a bank with a list of what you want. For example, don't let the bank tell you how much large cap growth to put in your portfolios. You tell the bank what you want, and you let them show you the products that they have. So the power balance has really changed. Now we see family offices taking control of their risk appetite, their asset allocation. They're not following every trend that comes out on the street. Suddenly Germany's going to outperform the U.S. or some trend will be pushed by Wall Street for a few months and then fizzle. The families aren't buying it. The families were out of China long before the general market was, because the bankers don't like to admit mistakes. So they don't pivot very quickly, but the family offices can pivot in a day and change their mind about something. So that's why they tend to be really leading investors. They're into these trends long before everybody else is, because they have no one to answer to but themselves.
And Carol, with kind of that topic in mind, how far out are you going at this point in time on the risk curve? You mentioned Nvidia really kind of setting the tone for AI and being a long-term buying opportunity. You're focusing on some of these big tech names. Are you dabbling in putting exposure into smaller, maybe emerging technologies?
Yeah, I mean, family offices tend to look at direct, smaller plays. So we go in at the very early stage, sometimes pre-seed or seed stage, into venture capital. We don't tend to be, in the pink sheets or the small publics. Those are in difficult places. That's why you see now a lot more companies staying private and then going public with $1 billion valuation, because there's a graveyard, unfortunately, with a lot of small caps. They'll rally for a few days and then they'll die again. So we take the bets in the small companies in directs or in private equity, not so much fun, sometimes funds, but more direct, frankly, and then go for the market leaders in the market. And that's how we sort of split the risk reward scenario there on the tech side.
What do your clients ask of you as it relates to alternative investments? And if to the extent they have that itch, how do you scratch that?
Oh, well, alternatives are a huge part of family office portfolios. Sometimes they're 30 or 40% of portfolios. Why? Because, again, family offices can go into things like venture debt. They can go into private lending. They can go into all kinds of, esoteric areas or very specialized real estate plays in an area that they know well. So alternatives are huge for family offices because generally there's more risk, there's less liquidity, but there's more return in alternatives. And that's something family offices can definitely handle. My family offices, I always have them have at least 2 years worth of expenses set aside in cash and money markets, earning 4 or 5%. And then we go take risk with longer term money. So they're very open and very interested in alternatives. Alternatives in real estate, funding biotechs, funding, research, genetic research. There's all sorts of very, very interesting deals that go family office to family office and never see the inside of JP Morgan or Goldman Sachs.
Carol, during my day job when I'm not hanging out with Paul, I write about the IPO market, and it still very much feels when I talk to venture capitalist investors as well as kind of some of the crossover funds that it is a investor-friendly market where you can walk away on valuation or pick up some of these shares of companies in the private markets at a steep discount. How are you putting money to work in the private arena, and how has that really shifted from a peak, just over 2 years ago?
Yeah, I think the private market, obviously, you can't expect a big and quick in and out right now. Markets are still very tenuous. I think they'll get less tenuous when rates come down a bit so that financing gets easier. But things have not, people are out there trying to beat up the small companies and get in at the good valuation. And, a valuation for a company that might have been 20 million is now 5, and it's heartbreaking for the entrepreneurs. So you can pick up some discounts in that respect because they're just people that couldn't get funded. But you still have to look for the fundamentals, which is a very strong team, a very strong, go back to Michael Porter, Competitive Advantage, Harvard Business School, read that book. It's a classic. Why is this company in existence and why should it win? Because if there's no winning strategy, it doesn't matter how cheap you get the company, it's just going to die. Because a lot of these companies are dying now because they can't. The old model was you just live on rounds and rounds of financing until eventually you pop. That model's gone. There's less tolerance for continually refunding a company that can't make earnings unless it's led by somebody huge, like the founder of Uber or something, where that guy knows how to do it. But for new startups, you're looking for cash flow a lot earlier. And and people are raising smaller rounds. So you get into you sprinkle into some small pre-seed rounds and then help the company grow is more the strategy these days, in my experience.
Gotcha. Carol, we only have about 30 seconds left. One of the stocks we talked about at the top of the show, Palo Alto Networks, down 26%. This is a big cybersecurity play. Are those the type of sell-offs that you would look to buy?
Absolutely. I don't happen to know that company very well, but yes. I mean, the market swings a lot. So you should have your favorite names, know why you like them, know how they're going to fit into your portfolio and what size you want, and then wait for the fear day. There'll be a fear day for Nvidia too. Even though it's so high, people have said to me, I can't get in. People were saying that about Amazon 10 years ago. Oh, it's too high, I can't get in. So those value guys miss the entire run. So just, hold your breath, hold your nose, and get in on a fear day to the stocks that you're interested in. And by the way, cybersecurity long-term is a very important play and trend.
Right.
That need is not going away.
All right, Carol, thank you so much for your time. Really appreciate it. Carol Pepper, president and founder and CEO of Pepper International, joining us via that Zoom thing from New York City. I appreciate getting a few minutes of your time.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Looking at Bitcoin here in memory of Matt Miller, since the March of last year, it's up about 155%. It just had such a huge move, and there's a lot of reasons behind that, including we got a spot Bitcoin ETF, which I think the crypto kids are all happy about. Kavita Gupta joins us. She's the founder and managing partner of Delta Blockchain Fund. She joins us on Zoom from New York City. Kavita, big move here in Bitcoin. I'd love to get your thoughts about kind of what's really driving it here over the last, kind of 8 to 9, 10 months.
First of all, Paul and Bailey, thank you for having me. I think it's been a very interesting journey. People in the space already knew that, of course, the anticipation of Bitcoin ETF, plus the halving of Bitcoin, which is about to happen in May, starting from April, which is going to make it more difficult to produce new Bitcoins.
Okay.
So the basic principle of economics of supply and demand is going to be off, are going to trigger a lot of Bitcoin movement in a positive direction.
And to the downside, though, with the underlying risk, a lot of uncertainty from the stock market's perspective, is 50,000 a support level? Kind of what do you look at when you're seeing potential downside, just given how volatile Bitcoin historically has been, pulling back from some of these big rallies?
Yeah, and I don't think this is an all-time high, as you said, that it is a support point. The support point may go down to early 40s or mid 40s, but I doubt it's going to go down before it reaches an all-time high, or we see a crypto summer end of this year to mid of next year back to 16 or in 20s anytime soon for a year or two. I feel like there is so much of new capital because of the Bitcoin ETF, which has come into the market, multi-billion dollars, that there is now going to be a continuous demand for Bitcoin.
So, Kavita, how else? I mean, should we expect an Ethereum Bitcoin? ETF going forward? Is that kind of the next thing you guys are looking for?
Ethereum is a technology, and Ether ETF. Yes, there is a conversation going on, and why not? Because at the end of the day, ETF is the way just for the institutional investors within US to be able to hold it in a much more credible manner and to have more capital injected in it. I am personally, honestly, at this point of time, if it's just the price or the technology from both perspective, more bullish on Ether than Bitcoin. I do feel like though Ether has been going between 2.9 to 3.1K in last 2-3 days. Again, I feel like even if it goes down a little bit, we're going to see the resting price in 2, but I am more bullish on Ether as an overall technology for Ethereum.
Okay, so you're bullish Ether over Bitcoin. Where else are you seeing opportunities? It seemed like Coinbase was seen as a big winner, and a number of these other platforms and technologies, just given the approval of the ETFs that Paul mentioned.
Yeah, I think within the space, there are a lot of technologies. The other layer twos, which I'm really bullish about, or the roll-ups, is optimism is a big one. I do see resurrection of Solana when the DeFi institution is going to happen. And a lot of DeFi, which is very similar to how the hedge funds work with USD or different currencies, the same thing with Ether, Bitcoin, and with the stable coins, we have decentralized financial products like Aave, Compound, a lot of lending protocols. I do feel like there's going to be an institutional staking around that, and that's going to really take over a lot of technology solutions. So I'm also a bit bullish on Celestia and different data layers too.
So Kavita, who are you talking to? You've got a fund, you invest in companies, you see very early stage companies out there. How broad do you think is the support out there for just crypto, blockchain? Because we still have the likes of a Jamie Dimon just giving it no love whatsoever. And I'm wondering just how deep your market is.
So you do have people like Jamie Dimon who doesn't love it and very vocal about it, but at the same time, the market continues, right? He has been vocal against it since 16 or 15, if I remember it correctly. And we didn't disappear. The market continued. It has become more strength. And I don't see a space where JP Morgan at any given point of time will not offer its clients an ETF option on Bitcoin or on Ether over time. So I do believe that the technology is here to stay. Now, what form of it is going to be there and what form of tokens going to be there, some crypto and some technology tokens, that we'll have to see within US. But one of the most interesting part about this space is it's very global. So one country, even if they have tried in the past, has not been able to really close the chapter on it. So we continues to see countries like Abu Dhabi coming up, giving licenses, or Singapore trying to be ahead of it, or countries in Europe from UK to Lisbon trying to be an amazing hub for the growth. So I just see a lot of growth in the space.
Well, Kavita, you can't talk about crypto without mentioning Binance and FTX. How do you approach investing given the fact that bulls will argue that bad actors are being flushed out, but on the flip side, it feels like that could just open up an opportunity for other people to take advantage?
So I think the game, anytime when there is finance and money and dollar involved in it, whether it's Madoff scheme or whether it's like anything out there, you are going to see scams, some sort of scams or some things which you don't have regulations and have a gray area, people really pushing beyond. So we do have FTX and Binance. And to be very honest, and I don't take away that what FTX did was completely stupid, which was very similar to Bernie Madoff's scheme, but also the lack of regulations. Even though you understand the space is here to stay, you are still doing ETFs, you have companies like Coinbase going IPO, which are signed by everyone. Lack of regulations from SEC is the biggest thing which hurts and push more fear or more scams around it. And I think that's where we should focus on.
All right, very good. Kavita, thank you so much for joining us. Kavita Gupta, founder and managing partner of Delta Blockchain Fund, based here in New York, and joining us via Zoom. And again, looking at Bitcoin here, 51,100 for Bitcoin. And that whole halving thing, halving, basically reducing the number of new Bitcoins that can be mined, kind of just puts that a further constraint on the supply. And then that's one side of the equation. The other side of the equation, as Mike McGlone explained it to me years ago, is presumably more use cases for Bitcoin. So fixed supply, presumably higher demand, that should push the price up. That's Mike McGlone's pitch to me, which I could understand.
Yeah, I mean, that's the kind of economics, right?
Yeah.
You know, you limit supply, increase demand, prices rise. When you look at from a seasonal perspective, one thing that stands out over the last decade, two of the three best months out of the year, April and May, but Bitcoin right now up 20% in February alone.
Yep.
Absent of, which is really not as in line with big tech as it had been historically. So interesting to see how that plays out. But
and the spot, having that spot ETF is big. And I guess there were 9 ETFs that came out. So presumably that's expanding the base of investors in this
that's what bulls
asset.
Say.
Yeah, that's what the bulls say. So we'll have to see. But again, ETFs, let's do a blockchain. Let's do it. Crypto ETF, and that is perfect, XBT.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.